Hello Australia, welcome to My Millennial Mates. I'm Glen James and we're joined today for a bonus episode with Bryce and Ren from Equity Mates, the podcast.
I like the name change.
Yeah, that was good, hey?
Yeah.
You like that?
Ren.
No, My Millennial Mates as well.
Oh, yeah,
that too.
You missed that one.
Yeah.
I got it. I couldn't work it out though. I was like, whatever.
So
We'll
as
roll
George
with
Costanza would say, let's just cut to the chase. This is a bonus episode. We're just answering questions about shares. And I'm going to open the episode with an audio question. And hey, everyone, if you want to ever send in an audio question, please do. glen.james@sortyourmoneyout.com. Any audio questions, keep them under a minute so they don't end up like a comment from Q&A.
It's like, was there a question there?
Yeah. So let's go with this first one from Shay.
Hi guys, my name's Shay. I'm 31 from Canberra and I love the show. My question is in relation to the stock market and if in fact there is a battle rhythm that we can learn about and perhaps use to our advantage. So I've heard that some sophisticated investors know that certain things happen throughout the year at certain times that affect the stock price. For example, in June, that hedge fund managers will pump money into certain stocks to try and get that last little bit of gain so they can report back better earnings at the end of the financial year. I've heard that towards Christmas, generally all stocks do a little bit better because people are feeling optimistic. And I've also heard that when a stock goes ex-dividend, it will drop in value for a period of time, whether that be a few weeks or a few months. So I'm just wondering if all this is just rubbish or there's some truth to it, and if so, what else have I left out? I'd love to know. Thanks, guys.
So thanks, Shay, for sending that in. And there was a question there. There's a lot of hocus pocus going on in the markets.
Yes.
Like from your experience, is it legit and does it matter? Are there any other things like, what do they say, like October's usually the worst or best month?
Buy in May and go away.
No, sell in May and
Sell
go
in May
away.
and go away.
Bryce, you've been getting that wrong for years.
Yeah.
I wonder why my portfolio's... Santa's Little Helper, which is the Christmas one. I mean, it's probably just a market trend over time. You couldn't really
So I think
attribute it to anything. But
there are specific things that happen in the market that if you're aware of, you can potentially benefit from in the short term. So when options are expiring is a big one. When indexes rebalance. So in our last episode, we talked about like the ASX 200 index. If it's rebalancing quarterly, companies that have made it into the index are now in the 200 biggest. At the quarterly rebalance, all the funds are going to have to buy them, and if you've fallen out of the index, you're going to get sold at the quarterly rebalance. So there's things like that happen. The dividend, the ex-dividend date is another one where share prices drop after the ex-dividend date, generally by the amount of the dividend paid.
Yeah.
So there are things like that. My more general piece of advice is a lot of that is noise, and a lot of that is used by very short-term traders, people who are trying to make money day in, day out, algorithms, quants, all that stuff, trying to get, fractions of cents here and a little bit of edge there. You don't need to be aware of that to make money in the share market. If you're investing for the long term, these things will happen. But if you're holding good companies or if you're holding broad indexes, over the long term, they won't matter.
Yeah, no, that's cool. And there's a question here from Brent Cunningham, which kind of flows onto that. And it was a question I was going to ask you that I don't know the answer to or really care what the answer is, but I'm interested to know. Like,
ask us anyway.
No, like I'm interested to know the answer, but I don't really care about the outcome. Considerations when choosing between ETFs that track the same index. Now, I want to know, like, do most, when they do rebalances, because there is a thing like if there's, say, Vanguard have an index fund and Beta shares have an index fund that track the same index, there's got to be some possible things that differ within the indexes, right? And it might mean that, and I guess my question was, do they all quarterly rebalance at the end of each quarter? Or do they say, okay, well, we're doing a quarterly rebalance, but we do that in our own time because that's our own IP? Like, because there's stuff behind the veil, right?
There definitely is. The first thing to know is that a lot of the times Beta shares or BlackRock, which is iShares, or Vanguard aren't actually creating the index. The index is created by another company. So the S&P 500, Standards & Poor, they actually create the S&P 500 index, and then all of those other asset managers then just track it.
Yeah.
And so that it's not like they're setting their own schedule for stuff like that, because they're just responsive to the S&P or Standard & Poor's. Same with like the FTSE, that's not created by Vanguard, that's created by another company.
But I guess the response, the way that each company responses might be slightly different.
It shouldn't be.
Yeah, I think they all try and, as soon as there's a quarterly rebalance from the Standards & Poor, let's use that example, then they all try and rebalance as soon as possible.
Where they try to differentiate is through their fee structure.
Exactly. Yeah.
That's the number one thing.
Yeah. So you've got this sort of, I would say, price war between your beta shares, Vanguards, BlackRock, particularly for, say, the index that tracks the ASX 200.
It's a race to the bottom.
Race to the bottom. Who can offer the cheapest ETF? Essentially, that's where they differentiate themselves. So, in direct answer to that question of what do you consider when they're tracking the same index, that would be your major consideration. Other things would be, who is actually providing the ETF, but personally, it's a fee thing for me.
You can get into the weeds on things like tracking error and stuff like that, where the ETF doesn't perfectly track the underlying index it's meant to be tracking. For broad-based market ETFs that most people are buying, that's not too much of a concern. That becomes more of a concern when you get into more exotic ETFs, where the ETF provider is using options and leverage and stuff to try and get a certain result. I think to Bryce's point, fees are the number one thing. We're enjoying this race to the bottom at the moment. Beta shares are currently leading in Australia.
Yeah, they got the cheapest A200.
Yeah, A200, 7 basis points, so 0.07%.
Yeah.
But who knows? Vanguard, BlackRock, beat them. Give us cheaper ETFs.
Is it 7 or 4?
Is it 4?
We'll have to fact check that one.
Yeah, and I guess I just want to jump in there and say, like, if you just joined us this episode, it is more of a direct Q&A. It's not really set at an introductory level.
Yep.
And we're going to share maybe at the end some of the shares that we are holding.
Yes.
And I'm going to talk about some darlings in my life.
Nice.
And we'll just use this opportunity to give a plug. If you do want something that's introductory level, the last episode we did, but also Get Started Investing, another podcast that you can search for wherever you're listening to this podcast now.
Love it. Now, Tom asks, how valuable is it to be invested in shares that give you franking credits? Now, franking credits, what are they quickly?
So basically, in Australia, we have a policy setting where if a company pays tax on profits and then pays you dividends out of those profits, you shouldn't be taxed a second time.
Yeah, it's to stop double taxation.
Exactly. Now, Australia's one. I think there's only 3 countries in the world that have fully franked dividends, so we are a little bit unique in that sense. But it's great for individual investors. It means we don't get taxed on our dividends in the same way that most other investors overseas do.
Personally, though, I don't buy stocks because they have a franking credit.
No, that's
It's
after
not-
the fact.
Yeah, it's not a consideration for me if they do offer it or not.
Yeah, and it's like, I really like what this company's doing, whether it's, an incumbent shopping centre or Woolworths or Coles. So I just like the company. I want to be a part of that because I see the future.
Yeah.
It could be the fact that, one, I don't care realistically if they pay dividends or not.
Yeah.
And then secondly, whether it's franked or not. I mean, to be honest, in financial planning land, if you do have a lot of wealth in super, in pension phase, like we set up a lot of funds that were heavy on franked dividends for the tax planning purposes, but you just don't want to make sure, you want to make sure that the dog's not wagging the tail's not wagging the dog.
Yeah,
Yes.
100%. Yeah. I think for, millennial audience, growth is more important than income at this point. We've got decades ahead of us before we need to get into our
Here's
retirement.
an interesting one, and it's harder to find. Like, so you look at the Australian exchange, like the All Ords index at the moment.
Yeah.
And it's basically done nothing for 10 years, right?
Yeah.
Basically.
Yeah.
Now, that's cute, but you'd have to look at the accumulation index of what it's actually done if you were to reinvest dividends.
Well, that's what a lot of people do. When you look at the return of the market, including dividends, it's done reasonably well.
Yeah, it's amazing.
Yeah. But to Ren's point earlier, Australian investors are very lucky in the sense that we Australian companies pay pretty well in terms of dividends. You look at America, for example, and it's pretty rare for companies to pay the level of dividends that they do here. And we're set up from a tax point of view.
Australia's a
benefit
tax
from that.
haven.
Exactly.
Yeah. America, some of the big companies pay quarterly though. That's nice. That's something different. If you pick the 3 right companies, you could get a dividend every month.
I think
That's
one of
not bad.
my investments, like direct, is a quarterly distribution.
Apple pay quarterly, so
Yeah.
that could be. But it's actually a lot of the big US companies.
I've
like
got a
Walmart
fund
and
that's
Visa.
an international fund.
Yeah.
I'll share a bit later that do quarterly
Yeah,
distributions. Yeah. Brent North asks, is playing the short game in shares any different than going to the casino? And why do some people believe they can beat the system?
Give them credit. You got to try and think that you can beat the system.
It is definitely different because the casino, you know the odds when you walk in and you know that they're stacked against you. The games are designed for the house to win. But obviously the share market is not that. It's not designed for you to lose. But it is very difficult to make money in the short term because you can do all the analysis that you want, but short-term price movements are more to do with psychology and other factors that you're not aware of or are outside of your control than it is to do with the fundamentals of a business. So it is difficult to have any edge in the short term, unless you've got a supercomputer or a few PhDs or a great algorithm handy. In saying that though, there are plenty of people who make money in the short term trading. It's just not our game and it's not something that we think we have a particular edge in.
And I'll probably just pull you up on that. Plenty of people, but in terms of percentage, very, very small.
Yes. There are lots. Yeah. 100%. Yeah.
Yeah. And I'll follow on. There's a question from Jessica Ellen. How do you respond to friends and fam who think buying shares is like gambling?
That's a really good question. And, a lot of people have that mentality that stocks is just like, that it's just like gambling. My response to that is, I think there are now many products. You could tell them that there are now many products that allow you to invest in the stock market that removes as much risk as possible, i.e. an ETF. And, you can spread out your risk and diversify, which I think, to people's argument around it's like putting all your money on one horse. Well, that's definitely not what the case is anymore.
Yeah, I think to add to that, I would just take it back from this abstract idea that we have that the share market is a bunch of numbers and a bunch of charts and a whole bunch of data that we look at daily and hear about on the news every night. What you're doing when you're buying a share is you're buying an ownership stake in the company. That company has purely been set up to hire the smartest people and, fund new operations and develop new products or services to create money and to create value for their shareholders. And when you think of it like that, when you take it out of this fast-moving chart and data situation to what you're actually doing when you're buying the asset, when you're buying the share, it's as far from gambling as possible. You're literally putting your money in one of the most productive vehicles that have ever existed, which is publicly traded companies.
Well, I think I would say to that, and people have asked me, buying shares is just like gambling. I was like, okay, let's just chill out for 2 seconds. What is gambling? We're playing a game of chance. That's kind of the definition of gambling, where buying shares and equities is actually called investing. Now, if I and I've said to people, do you fundamentally believe that Woolworths supermarket will be around for another 50 years? Do you actually believe that we'll still need to shop in a shopping centre in a supermarket? Yes. Okay. So I can actually buy, as you said, a stake in that going concern. So I'm actually investing, and that's not a game of chance. It is if it's penny stocks and flip a coin whether this company is around next year, but we're talking about legitimate businesses who have a long-term track record.
100%, yeah.
And then I would also say to that same person, there is more of a gamble not to invest than to invest.
Yes. The biggest risk is not investing at all.
Yeah. And the biggest... I heard a quote once, and I need to find what it is. And if anyone can find it on the web, on the interwebs or whatever, I always sound old when I try and can you Google something? Get the Google up. There's a quote, and it's the guy said, I forget who it is. Maybe Nath can look it up on Google now. It was something about the biggest travesty was not the stock market crash in 1962 or whatever. The biggest travesty is people not investing into the market every week. Something like that.
Yeah.
It's like there's more of a risk not
Absolutely.
to invest.
Absolutely.
Yeah, and if
You filthy capitalist pigs.
Couldn't agree more.
we see the media perception of the stock market is we get this day in, day out, Alan Kohler on ABC News, up 2%, down 2%. And then when the market crashes, you get, massive coverage of the crash and how much money has been lost. If we think back to March when COVID really hit, it was the front page of every newspaper. It was the top story in every news bulletin. And if that's your only exposure to the market, this thing that we don't really understand day in and day out and then has massive crashes every now and then, of course you're going to be resistant to putting your money in it. When you look at, housing or, any other asset, bonds, whatever it is, which feel a lot safer. But to your point, Woolies is going to be around in 50 years. Commonwealth Bank's going to be around in 50 years.
Amazon.
And it's
Amazon
actually,
will own the world in 50 years.
I don't think it's like, and this is very scandalous, but theoretically, and again, I just want to reaffirm that I'm not a licensed financial advisor. I'm just a guy having a chat. But theoretically, there shouldn't be a need to have a conservative portion in your portfolio, a defensive portion at any age. Theoretically. Because it speaks to managing risk.
Yes.
And managing the emotional risk.
Yeah.
Because once you invest and set up your money correctly, if it's set up correctly, you should never need to sell the equities, which means it doesn't matter what the face value is doing. Because anyway, I don't like the discussions like, oh, should we invest in like 40% bonds and fixed interest? Like you're only doing that to smooth your return out.
Yeah.
Yeah, it goes down the whole rabbit hole of like the volatility and is volatility risk and all of that. But I don't think we need to go too deep.
No, let's go deep. Do you want to?
Well, I mean,
no, I've got heaps of questions, but it's a philosophical thing. It's like because I know some advisors that they're high touch with their clients and they've got people in their 80s in a 100% growth portfolio because they understand how the markets work.
Yeah. Investing is all about risk management.
Yeah.
That's what
and
it
then
boils
that
down
speaks to, okay, so if you are going to invest and have a strategy that's 100% equities or 100% growth, for your own financial planning, you might be cash heavy to have a year's worth of income or 2 years worth of income. So, if you do need money, because people go, oh, you've heard all the stories. Oh, uncle lost all his money in the GFC. Yeah. No, he didn't. He sold at the worst time out of fear and didn't get back into the market and he did his ass.
Yeah.
Yeah.
You don't lose money if you don't sell.
Like you look at the last
Quote,
6 months. Yeah. All right,
Write
Gandhi.
that down.
Yeah.
I think you're the first person that said it.
If you look at the last 6 months with this COVID correction, like, what's the problem?
Yeah, exactly.
Like my portfolio, it's in the top 10% on net wealth. Or no, what's
Self-wealth.
net worth?
Self-wealth.
Net wealth's another platform. But you know what I mean? Like,
Yeah.
and it's pretty high growth, and I didn't dick around or touch it.
Yeah.
And it's fared well.
Yeah.
And you got to remember the media, a lot of these brokerage platforms encourage you to trade every day, trade in and out of positions because that's how they make their money. They make their money from activity, from clicks, from buying and selling. So, and you just got to cut that noise out because you're right. If you had held your portfolio from February to July, you're probably up or at least, close to flat. But so many people panic sell.
You've got to go through that experience to understand how you're going to react to it, though. I think you've got to, mastering your emotions in investing is incredibly difficult.
Yeah, I told my clients, like, they'd come in for a review and like, oh, hey, the portfolio did 8%, like 12 months after fees and everything. It's like, yeah, that's amazing. And I always go, look, hey, you're going to come in here 1 year and it's going to say -2. Like, I can guarantee you will see a negative, but that's okay because it's just face value and we do not need to access the capital. So it's an education piece.
Yeah.
And I've taken the view, and I think one of yous maybe I read on your website,
We haven't updated that
This
in
is
a while.
dangerous.
So.
Where's this going?
Yeah, you got to update your website. But
This is the gotcha question.
yeah, this is the got you one. No, it was about. Oh, now I've lost my train of thought. It was about investing.
Yeah.
I'll move on. It might
So
come.
you were saying 8% a year, and then 1 year it's going to be -2.
Emotions.
Yeah. What I developed, and I think, Bryce, you made this quote. Someone said, save to invest, don't save to save.
Yeah.
So I had to resolve in my life that I'm really bad at saving money because I'm a spender. So I've had to set up my money. So once the money's committed to investing, it stays there.
Yeah.
So I'm terrible at saving money. I'll be the first to say that. But I'm an investor, not a saver.
Yeah, I'm the same. I get paid monthly, which I hate.
Oh,
yeah.
Yeah.
You
Same.
need the Glen James spending plan.
I do.
I'll get you a code. You should do it.
Yeah, I will. I'm the same as you. I'm a terrible saver. But what I do to try and get around that is I get paid monthly. I know how much I should be saving, and I transfer that directly into my brokerage account straight away. And so I don't invest it straight away, but it's in the brokerage account. It's difficult to then get it out. You know, there's a few day delays and stuff like that. So it's out of sight, out of mind.
Yeah, on that, that's a good segue. I think we forgot in the last episode to talk about DCA and what it means. But I want to talk, one, I'll get one of you to explain DCA. And then two, I'll talk about how do you guys suggest people, if they don't use like a managed fund or a platform, to manually execute trades. So DCA, what's that?
DCA stands for dollar cost averaging. It's an investment strategy, I guess, where you take the same amount of money and invest it into the market at a specific cadence or particular points in time. And by doing so, investing the same amount of money into the same stocks or ETFs, you're buying in at different prices each time. And in doing so, smooth out your average price. And by doing so, you reduce your risk if the prices drop or smash through the roof.
And Vanguard just came out, I think it was them, and debunked that. Well, someone that
That's
says...
massive from them.
Yeah,
So-
it might not have been. Sorry, Vanguard.
No, there's been studies where it's like, if you have a lump sum, is it better to just put the lump sum in
Yes.
at the start?
Yes.
Or to do like...
DCA it,
Yeah, to
yeah.
DCA. And the lump sum actually always performs better.
Yes.
But there's obviously like an emotional thing. Like, can you manage that?
Yeah.
And then the second thing is, most people don't start with a big lump sum of money. Like,
Totally.
dollar cost averaging is the investing for, people that get paid a salary.
Yeah, so theoretically, everybody who is on salary that gets 9.5% super is dollar cost averaging into
That's
the
the
super
best
fund.
example of
100%.
it.
Now, when I had my financial planning business with clients, we used to call it new money. So if there was new money that came into the market, so if someone had an inheritance of 200 grand, they were new to this investing thing. On the emotional side, I would always talk them through the DCA approach, and more for the emotional side, let's smooth it out. And what I usually did was threw half of it in straight away and then DCA'd the remaining half over 6 months.
Yeah.
Sometimes you might tweak it depending on their risk profile, but it was just more of a emotional thing. So
Yeah.
That's all it is. It's if you're comfortable putting your 10 grand in one hit, then go for it.
Yeah,
But
and I mean, I don't, as a general rule, do lumpy investing. Like, it's pretty systemated and automated because it removes me from
Yes.
trying to time
Yeah.
things and gamble.
And I think
that's-
that is the most important thing with dollar cost averaging.
Yeah.
It's if you're doing it at a set rate, once a quarter, once a month, you're not trying to time the market. You're not saying, oh, just wait another 2 weeks. It might fall a little more. It might be a little bit better. You just take that, personal
stress.
decision making out of it, and you systematize it. I think that's exactly right.
And I was actually forgot to say it to Shay's question. All his examples and all these old wives' tales and what the markets do, to me, don't care.
Yeah, doesn't
Because
matter.
every month I put money into the market.
Yeah.
Now, I will say, and it's probably the first time I've said it publicly, because I wasn't going to say it during the whole COVID thing. If you are in a good financial position and you might be cash heavy, there are times where I've reversed the semi-trailer up and tipped it into the market.
Oh yeah, of course.
Now, that's not me timing the market-ish. It's more, hey,
being opportunistic.
thank you. Like I've got some spare cash laying around.
Yeah.
I went in pretty hard in March, April.
Same.
Yeah,
But at the time, I'm not publicly going to say, "Oh, everyone throw X amount into like," because it's a again like people listen to this stuff.
Yeah. And if you're wrong,
but it's more of a public policy. Don't time the market just month on month.
Yeah.
But there could be times where you've come into some money, and and the thing is in April and in March and April, if I didn't have spare cash laying around, I couldn't have done it anyway.
So I think there's a story, and I might butcher the numbers slightly, but I'm going to try it anyway. So obviously, the GFC turned out to be a great buying opportunity. I think if you bought at the bottom, you would have close to tripled your money if you just bought a US S&P 500
delicious
index, which is great, and you'd be stoked. But if you had bought... What was the first? Lehman Brothers. So Lehman Brothers collapsed on a Monday. If you bought the US S&P 500 index on the Friday before Lehman Brothers collapsed on the Monday, held it through the GFC, and then back out the other side, I think you still would have close to doubled your money in the 10 years after. It's just the long-term grind up of the market just is relentless.
And it's happening pretty quickly right now.
It's happening pretty quickly right now. So even if you bought at the worst possible time, like the very worst time, the market recovers. Historically, it has always recovered. Hopefully, it will continue to do so.
What do they say? You make all your money in a bear market. You just don't know it at the time.
Yeah. So I think obviously, you want to, when you get an opportunistic time like during COVID or like during the GFC, you do want to back the truck up. But even if you completely butcher the timing, you shouldn't lose sleep over it.
And that's what I mean. Like, sure, if I back the truck up and put it in, if I was a week off and then it dropped another 5% the next week, it actually doesn't matter because I'm not selling for 30 years.
You don't need the cash.
But it was just, I had spare cash at the time. There was an opportune buy. That might only happen every 3 or 4 years.
Yeah.
If I've got the money.
And I think Bryce had some strategy where you put a certain amount of money in depending on how much it fell.
Yeah, my kind of thinking was if it drops 10%, I'm just going to put in 10% of my cash available.
Oh, that's cool.
Drops another 10, I'll put in another 10. That way I'm kind of averaging in as it goes down and not trying to time when's the bottom.
And I think having guidelines, because I'm big on percentages and guidelines, because it just removes you and your emotion.
Exactly. And I'm quite an emotional investor. I've been
so emotional, unbelievable.
Do you want to grab those tissues?
I've come up short because of my emotions sometimes, but yeah, that's why I have to put these strategies in place.
And when we went for a walk to the cafe just before, I was telling you guys how I came into some money unexpectedly.
Yep.
And I don't need to meet any other goals, so that money's going straight into the market.
Yeah.
And I've just got to work out whether it's super or my investment bond or through my trust. Either way, it's being invested for the long term because I don't need it, and I don't want to just spend it on more crap that I don't need.
More cameras.
You can get more cameras.
Hey, you guys are guests here.
True.
So
no, look, we are very jealous of the cameras.
Yeah. Now, Jake Wilcox, hey mate, how are you? From Townsville. I sent you up a tote bag. Hope you got it well, and say hi to your sister for me. And that's not like a...
I was like, what?
No.
Hold on a second.
No, that's... Hi, Shannon. Jake asks... that's embarrassing.
Keep it in.
Can you please discuss the different taxes around shares? This is a good one. If my investment value increases, what taxes do I pay? When I sell, what do I pay? And I always crap on with John about... property, it's the only asset class where you pay on the way in, you pay during, and you pay on the way out. So talk to us about taxes.
The two main ones, I guess, to consider are your capital gains tax, which is the tax that you have to pay on selling a stock when it goes up in price and you make a profit. Or any asset for that matter, yes. Then the other one is if you are getting paid dividends, you're getting income, and that will go towards your... taxable income. They're the two main ones. If your stock goes up and you don't sell, you don't pay.
Yeah. It's only when you sell there's a tax event, and then you need to worry about it.
Or throughout the year.
Or when you get dividends.
Dividends.
Yeah.
Yeah, and that's, I guess, as a parallel, when you buy an investment property, you may pay stamp duty on the way in, which is a percentage. So when I buy shares, I don't pay tax on the way in. If I meet the investment property threshold, I might have to pay land tax throughout the holding the asset. I don't have to pay really. If I've got a share that doesn't pay dividends,
Sweet.
I don't pay any tax ongoing.
Hopefully the government aren't hearing this. They might get some ideas.
Yeah.
And that's why we love equities.
Yeah, and I'll just finish.
Oh,
and
sorry.
then And then with the property, because it still isn't an asset, like shares, once you sell that asset, any gain is taxed, capital gains tax.
Yeah.
And I will just add, if you, and we'll talk about dividend reinvestment and stuff like that, but if you do reinvest your dividend, you will still have to pay tax on that because it's deemed earnings and it's just after the fact that it's been reinvested.
Yes.
So there's no way around tax evasion.
Yes. There are...
I was going to go down the base yourself in the Cayman Islands, all of that route, but we'll leave that one.
And Google ATO Part 4A.
And this is why we love equities. And, you know, I'm not saying properties is not a good idea at all. And at some point in time, I want to buy a house as well. But it's just so cheap to get access to such good quality companies at, you know, relative to your point, Glenn. Stamp duty is just, it can kill you if you, like, costs so much to buy a house.
And particularly if you make the wrong decision around pulling the trigger on such a big investment that's leveraged, because I don't know
That's the
many
other
people
thing,
that are buying investment properties outright. So do you guys, like, if we can get personal,
Please.
do you guys, like, your equity mates, like, are you best friends that live together? What's your personal sitch? Like, do you
I thought
hang
you were going
out?
to ask us if we own property, but
Oh, yeah,
you're going
well-
very personal.
No, but like, I wanted to get to know the person.
Alec and I met at uni.
Yeah.
We lived together at uni for a while.
Cute.
Yeah. And then I have just moved out of a share house with mates that we'd been living with together since uni.
Oh, wow.
Alec's taken my room. I've moved out with my partner. And now Alec is in that room. So,
Wow.
yeah. We spend a lot of time
Mercury and
together.
Venus have aligned. What? How old are you guys?
I'm 29.
29?
27.
Yeah, that's cute.
Yeah.
Love it.
Yeah.
Any other personal things we need to know about?
What do you want to know?
I don't know. Whatever.
I support the Essendon Football Club.
Oh, really?
Yeah.
I'm friends with Sean Wellman, who used to play for
yeah.
Essendon. Yeah.
Yeah.
He's our mortgage broker, one of our mortgage brokers in Melbourne.
Yeah, right.
Yeah. What up, Welly?
There you go.
Shout out.
Do you do any sport stuff?
Yeah, I support the Swans.
Hey,
Sydney
Swanee.
Swans. Yeah. You friends with any of them?
A few of them follow us on Instagram and listen to the show.
Yeah.
There you go. That's not bad.
Yeah. John does some property coaching with GWS and the Swans.
Yeah.
We had one of the GWS players on the podcast once. What was his name? He was a cool guy. So it's really bad. Hello, if you're listening.
Adam Kennedy.
He was a cool guy. Anyway,
Yeah.
yeah, I'm a bogan. I like motorsport.
Okay.
you
Interesting.
go.
Would
Yeah.
not have picked that. But
There
you,
you go.
but you have a Volvo in the driveway.
Yeah.
So
I'll take you for a drive in it, and then you freaking re-comment on that. You'll be shatting your pants.
yeah, I'm sure.
Yeah.
Bryce just bought a Jazz, so, you know, he knows.
What do you drive?
Mazda 3. Good
Okay.
car. Mazda 3 Sport, I should say.
Oh, sorry.
One of the best.
Got those paddle shifters happening. All right, we're gonna get some. I'll get the negative comments on my feed for crapping on. Go comment on their podcast, everyone. And if you are listening and you like the crap that we do, give out both our podcasts on Apple a 5-star and some nice words.
Yeah. If you have an issue, don't take it out on the rating system. Come to us
No,
personally.
I would say
Honestly.
I want people, if you've actually got an issue, still press 5-star and then shred me in the text.
And then, yeah. Not a bad play.
The very first piece of critical feedback, we'll call it, that we ever received, Bryce wrote a very lovely reply and managed to turn them around, and now they're a dedicated listener of the show.
How do you do that? Like
So-
on Facebook?
No, this
over
was
email.
email.
Yeah.
So if you're not enjoying our banter, write to us, and Bryce will try and turn you around.
Yeah. Okay. Sorry, I think it's just good. Like some of that crap that we just talked about, you guys might not talk about on your podcast. So
Absolutely.
it's getting to know the guys.
Yeah, absolutely.
How many people in the share house?
3.
Oh, it's not too bad.
Yes. At uni, I lived it with 6 others at one stage. That was That was big.
Lauren, and I don't think this is her last name, but on Facebook it's Where's My Phone? This is a bit of a loaded question, and I'll just quickly answer it unless you guys think it's categorically incorrect. She says, what percentage of your income should you invest? My answer is always as much as possible.
Yeah. How long's a piece of string sort of thing?
Double as half.
Not bad.
I love that.
Not bad.
Yeah.
Laura, yeah, so, but in all seriousness, you want to invest as much as you can.
Yeah.
I mean, there's trade-offs in life. It's like if I want to travel to Prague once a year and it costs me $5,000, well, I've got to pay that $5,000 to travel to Prague. If I don't want to do that and I'd rather invest the money, well, that's the trade-off that I've made.
Yeah, 100%.
And just to that, whatever you do, Lauren, Where's My Phone? I would say just systemate it, automate it, so you are removed from the equation. Like my personal investment account or whatever, it just every month it goes in. I don't even know how much is in there, to be honest, because it's just I don't look. It's just more just doing the Glen of tomorrow a favour today.
Yeah.
So as much as you can, clear your debt first. You might decide that you want to put some big chunks in your life first, like I want to save for that home deposit. So you might not go as hard on investing, but yeah, as much as you can. There's no right or wrong answer there.
Yeah, I agree.
Yeah.
Laura asks, once you've established your portfolio, what would you say is a good amount to keep contributing each year to see continued growth? And I guess I put them together because they're kind of the same answer, but
yeah, exactly the same answer. I don't think there's a hard and fast rule about if you start with $5,000, then every month after that put in $500. Like it's whatever you can afford to do.
Yeah. And your circumstances will change. Like if you're young enough and you have a job but you don't have a family and a mortgage, then that's the time to sort of front load it. And then when you get more obligations and stuff, probably put in less. Things change. It's just consistency.
And I just want to read a little bit deeper into Laura's question, just so I'm not seeing it in a simplistic way. What would you say is a good amount to keep contributing to see continued growth? So I want to answer that is you've put $5,000 in, and we'll just say that I'll make up a number over the last 7 years, Australian equities, and probably hasn't, I'm just making up a number, has grown 10%.
Yeah.
So, Laura, if you put $5,000 in to your your share investment, whatever that is, and if it was a 10% growth over the 7 years, theoretically, at the end of the 7 years, you will have more than what you started. You'll have 550 at least.
Yeah, you don't have to put more in to see growth.
Exactly. So I think that's kind of, it might have been the angle that she was going to.
Yeah, right. Yeah.
So it will kind of, because a lot of people say, my fees are eating my super fund. Theoretically only happens if you've got a very low super balance.
And I think that the beauty of compounding is that over time, if you're consistently growing at 8 or 10% a year, that number starts to get very big and starts to snowball very quickly. It helps if you contribute, but you don't have to contribute to enjoy that benefit of compounding. It's just time.
Caitlin asks, hi Glenn. Hi Caitlin. I have a couple of questions. 1, what are some strategies to diversify your share portfolio? 2, what happens with reinvestment of dividends if the dividends are less than the cost of one unit?
Good question.
So we'll start with the dividend one. So one share, we'll just say it's a $30 share, and the dividend that you receive that's on a DRP, dividend reinvesting investing plan, is $25. What happens?
It just sits either with the registry. And they then hold that until the next dividend is paid out by the company, and should that then be enough to buy a unit in the company, they will do so, and it just keeps on rolling on.
Correct me if I'm wrong, but would they ever let you know if you want to cash that out or change the DRP?
I think you can decide that at any point in time.
Yeah. Okay.
But I mean, I don't see the value in taking half a stock worth of dividend. Like, just let it sit in there.
Righto money bags over here.
Yeah. Oh, I noticed you do have a sore shoulder. Rolling in all his money. I'm a fan of DRP, dividend reinvesting.
Yes.
Now, what are the top 2 reasons that you would DRP?
Personally?
Oh, just whatever.
Well, I mean, there's probably some tax advantage that I'm not aware of that you're probably going to tell us. But
I don't know.
I think...
What's the main one?
Compound for me, compound growth.
Okay.
It's just an ability to continuously build your position in that company over time, and that then leads to greater return if you have more stake in a company.
And the second one?
I feel like there's a loaded question. I feel there's an answer.
There is.
I'm going to flip it around to you. What's the second one?
Second one is you can buy a small parcel of shares without the brokerage.
True.
Oh, that's I hadn't actually thought of that. Yeah, that's a good one.
So you're listening to Equity Mates, and there's a new mate on the block. His name's Glen James. So I'm a fan of DRP for that reason. More shares into the company without paying an extra $20 in brokerage or whatever it is.
Yeah.
So
No, that's good.
and I guess the third reason, the emotional play, you've got the compounding there, but your mitts never get on it anyway. So it's not as if I've got a $200 deposit in my bank account. Yay, fun, new pair of jeans. It's just set, forget.
Yeah, well, our kind of comment is if you're not going to do a dividend reinvestment plan, fine. But our feeling is if you take the money, make sure it goes back into the market somehow. If it is to go and buy new jeans, then you probably want to keep it in.
Yeah, and I mean, for example, spoiler alert for the back end of this episode, I hold VTS and they don't do DRP. So that I've just elected the bank account being my brokerage bank account. So it never gets into Glen James's life.
Yeah, smart.
Okay, ticking things off. Now,
should we answer that diversification question as well?
Yeah. So Laura's question, how do you diversify, blah, blah, blah.
So diversification is a...
Oh, sorry, Caitlin. Sorry.
That's all right. Diversification is a big topic and people take it a lot of different ways. I think the way that I like to think about it is just there are a number of sources of risk for your investments, and what you want to do is not be overly exposed to one particular source of risk. So it's not...
What are some of those areas of risk?
Yeah, so it's not just about owning, X number of companies. And so, to get into some of the different risks, you might have industry or sector specific risks. So, for example, retail is getting disrupted by Amazon in a lot of countries. And so if you owned, 5 or 6 retail stocks, you may own a number of stocks, but they're all exposed to the same risk. There's also country specific risks. So Australia could have something happen to it or have something happen to its economy that the rest of the world doesn't experience. And so if you only own Australian shares, then you're exposed to the same source of risk in all of your shares. And so there's different ways you can think about diversification. You can think about it through different assets. So, property, stocks, bonds, cash is diversifying different assets. Geographic diversification, so Australia, the US, Europe, and then also like industry or sector diversification.
And even like if you bring it right back home to your own portfolio. I can't reach my pen. Oh, damn it, I'm going to have to take it up. Oh, you get that for me? Thanks, mate. You're a keeper. It's to me the biggest one in the first episode we talked about the core satellite, and maybe I suggested 10%. It's the single stock risk in your own portfolio.
100%. Yeah,
if you want to bring it right home.
Yeah.
So how are some strategies to diversify? Well, diversify your share portfolio are strategies to buy more shares. Like in its purest form, if you own 100% of CBA shares and you want to diversify your portfolio, you might go and buy some Woolworths.
Yes.
All of a sudden, you've split the single stock risk and also you've split the sector risk.
So a really good example of a share portfolio that isn't diversified would be if you just only owned the big 4 banks in Australia, because whilst you're owning 4 different things, they're all exposed to the same risks. They're all in the same geography. And so whilst you own multiple things, the reasons why those investments would lose you money are all really the same. So I think, if you think about diversification as a risk management strategy rather than I need X number of assets or X number of stocks, that probably helps you conceptualize how diversified am I actually.
Yeah. Oh, that's good. There's a question here from Paul. How do you find the sweet spot with DCA or dollar cost averaging where the benefits outweigh the cost of increased brokerage fees due to more frequent purchases. So I guess just quickly, I would probably say to that, you talked about rules, like percentage rules. What I would probably do is, because once you have a brokerage account, there is manual stuff involved. Okay, it's different than a managed fund. You've manually got to place a trade. So what I would recommend, based on rules in your life and your own cash flow, you might, if you've got the Glen James spending plan, you might have a line item. You plug your stuff, I'll plug mine. You might have a line item in your cash hub, which is investing, and I'll just make a number up, $200 a month. And you automatically transfer $200 a month, $50 a week, whatever you choose, over to your trading bank account. And then you've got your own rule that I will place a trade when that brokerage account gets to $2,500, $3,000, whatever that is.
Yeah.
Whatever that rule is. If you're balling in cash, it might be, as soon as it gets to $50,000, I'll place a trade. So the way that I suggest people look at manually DCAing, I don't think it's more of a manual, I do it monthly. I think it's set an amount in your life, and then you put that in, whatever the market's doing.
Yeah, I like that.
Yeah.
I think the other thing, if you are worried about brokerage, paying it, every increment of money you have or every increment of time that you want to invest in, there are ways that you can do sort of off-market funds where you avoid brokerage. So Vanguard, which is a big ETF provider, you can buy an ETF through the stock market, or you can sign up to similar funds as private funds. There's generally there's a
It'd be minimums, wouldn't they? Like 20, 50 grand maybe?
Initial lump sum.
Yeah.
But then what they allow you to do is pay smaller amounts in, and then there's no brokerage there. And same sort of setup with a number of private funds that are like actively managed. There's generally a big initial lump sum, but then you can DCA in smaller amounts. So that is another option.
And I think another consideration with your investing is the paperwork factor.
Hate the paperwork.
And that's why one of the reasons I don't do anything in my own name is because if it's through my brokerage account in my family trust, the bookkeeper's doing the paperwork automatically anyway. So
nice.
Must be nice having a family trust.
And then through my investment bond, that's internally taxed, so that doesn't need to go on my investment, like my personal tax return. And then the super's internally taxed. So I'm more of making my life simple. So with your considerations, like I would say that off-market stuff that you're talking about, that's if you got some serious dollars, I would imagine.
Yeah,
I think the Vanguard one's $5,000 to kick off.
Yeah. I was looking at one of those private,
but they're just
funds.
managed fund, aren't they?
A lot of them are.
Yeah.
The Vanguard ones are just index funds.
Yeah, which is a managed fund.
Yeah.
Like they do all your tax reporting and all that at the end of the year anyway.
Yeah, I believe so.
Yeah. So there's a little question here from David. Investing in ETFs versus LICs. So just tell, and some brief pros and cons. So the listed investment companies, how do they kind of work?
LICs, listed investment company. Essentially what you're doing with a listed investment company is buying a share for the company, and then they actually take that money and manage it themselves. Whereas an ETF, you're buying into a pool of stocks. There's some differences in the way that they're set up. I don't know if you want to go down that track, but essentially what you're doing with the listed investment fund is you're really backing the company or the manager and getting them to actively manage your money.
Yeah, and the LIC is probably on the scope of what we're wanting to do today anyway. But now let's just let's kind of finish up with. Do you guys share what you hold?
Yeah.
So what are you guys holding at the moment?
A little bit. Now, we need to give the very clear disclaimer that this is personal. No, we're not advising you to buy, hold, or sell or anything like that.
You're just sharing your story.
Exactly.
Yes.
Exactly.
As Oprah would say, I want you to find your truth.
That'd be an interesting interview. Oprah and stocks.
We'll try and get her on.
She's like, we don't touch anything under like 8 mil.
That's Bryce's investing philosophy as well.
Yeah, I bet. Couple of boys from the inner city, what?
What do we hold? What do I hold? I hold a number of ETFs. I hold GEAR, GJust, both leveraged.
How are you leveraging?
Well, they're internally
internally
leveraged.
geared. Yeah.
I have also a leveraged position in Magellan Private Fund through NAB Trade Equity Builder, which is a product that essentially acts the same as a mortgage. I own.
What's the LVR?
70. It depends on the asset, but 70% for the Magellan that I'm in at the moment.
Is that what Magellan fund is it?
Global equities.
I'm in that.
Yeah, it's good.
I love it.
Yeah.
I've got such a boner for Magellan.
Hamish, yeah.
Did you go to the Sydney Investor Update?
We couldn't make it. No.
Oh, really?
Yeah.
Oh, I loved it. Anyway.
I would have loved to have gone. I saw some videos of it and it looked like a TED talk. I was like,
he's like, he is the GOAT of international investing in Australia.
Yeah,
in my
I agree.
view.
yeah. Well, he's a billionaire.
Is he?
Yeah.
He's a billionaire.
Gosh.
Yeah.
I want to get
Because
him
of
on
his-
the podcast.
And this is a good
Yeah,
example
same.
of. This is a good example.
I'll do it.
Well, we've had Chris, who's his deputy in chief.
Yeah, that's cute. I want Hamish.
Yeah, well, if you get him on, flick him across.
I've
our
actually
way.
had it. I'm derailing this, but I met Hamish like 15 years ago when he first started Magellan.
Oh wow.
Yeah.
Well, that's how he's made all his money. He's got his obviously
Well,
equity.
the 1.3% fee. Whatever it is.
Anyway, so yeah, I've got that. I hold Afterpay, hold Brickworks, which is an LIC. I hold Macquarie, Self Wealth. What else? Gee, I can't really remember.
Self Wealth. Are they listed, are they?
Yeah.
Yeah. Oh, actually, I didn't know that. Yeah.
Yeah, actually just bought them 2 days ago, 2 or 3 days
Yeah.
ago.
For this interview.
For this interview.
Yeah, a bunch of other stuff. I mean, I can't think of them all on the spot, but
So for me, if we go the core and satellite approach, my core is mainly ETFs and then a few managed funds. So similar to Bryce, I got a NAB equity builder loan and bought into Magellan. We've interviewed Chris Weldon twice on our podcast and was just so blown away by how smart he was and how clear thinking he was. I was like, well, it would be dumb not to invest.
even though he doesn't manage the fund that we've invested in.
Okay, in all seriousness, I know someone who works at Magellan pretty well. I will...
Emma?
No. I will see if I can get us three to sit down with Hamish and we'll do a joint interview.
That'd be epic.
Great.
Yeah,
Love
because
it.
we've asked twice and they have respectfully given us someone else.
Really?
Yeah.
Yeah.
I mean, he's busy,
He's very
Oh,
busy.
yeah.
Yeah.
but we're busy as well.
But the guy they gave, Chris Weldon, was fantastic.
Yeah,
unbelievable. Yeah.
So anyway, Magellan, and then a number of ETFs. So ASX 200 ETF, the beta shares one because it's the lowest fees. A couple of overseas ETFs, an S&P 500 one, a NASDAQ one, which I know overlaps, but it's a little bit more of concentrated exposure to some of those big US tech names. A core of ETFs try to be geographically diversified. Ooh. And then in terms of my satellite, there's a few individual stocks. So obviously some of the big, what are we calling it now, fan mag or whatever, the Facebooks, Apples, Microsoft, Netflix of the world. But I'm also particularly interested in that second tier of US tech names. So your Shopify, your Adobes, Spotify is an interesting
Spotify, yeah.
company.
You need to buy Magellan, my friend.
So I think there's a lot of really interesting stuff happening over there. Like we all know that software is eating the world. We all know that these tech companies are huge, but there's a lot of focus on that top tier, those top 6, and I think there's a lot of similar unit economics, similar really good businesses below that. Then there's also a number of themes that I'm particularly interested in. So sustainability is obviously a big one, and I think there's going to be some pretty clear winners in that space. Some of the big waste management companies around the world will do quite well. And then just, some other individual companies that, I like or that I'm interested in. That's it. What about you?
Well, I'm glad you asked, and I guess this is the first time I've ever publicly talked about the equities that I hold.
Great.
I'm scared to. I don't know.
Looking forward to
We
it.
feel honoured
I mean,
to...
it's boring. I mean, it's
like
so
one
boring.
stock.
Yeah.
BTS.
Afterpay. No. So I've said this before on the podcast. My super fund, it is with Sun Super. And I think I got it wrong when I said, but it's kind of the same. I think it's 80% in the consciously social balanced fund.
Yep.
And because I think I said 70 on the other podcast, and then 20% they've got an international emerging markets index or something. So my own view is I don't heaps care about Australian equities, because when you look at it, Australia under 30 million people. There's that many people in Greater LA. So my view is I'm getting off the island.
Yeah, it's 2% of the global share market is Australia.
So I'm pretty heavy international. So that's my Sun Super 80/20 core satellite there. My investment bond, I think, and I actually forget, but it's either the Vanguard Diversified High Growth or the MLC Income Builder, which is a portfolio that just invests in Australian equities that have high dividend.
So you're not quite off the island.
Not quite, but and that's what I mean. I think because I've got, to be honest, I haven't logged in to that account. I don't because it's like, you'll just keep shoveling.
Yeah.
In my brokerage account on Self-Wealth, I've got, and I'm not going to tell you the weighting of this, anyone. I've got VTS, which is basically the total market of the US stock exchange.
Yep.
And I guess the reason I've done that is, one, the US growth in itself, and investing in the American index, you get indirect exposure to emerging markets around the world. Like Starbucks, there's a new Starbucks opening in China every 15 hours. Like
that stat just blows my mind.
That blows your mind. So I do have exposure to China. I do have exposure to, remember the old BRICS? Do you remember that?
Yeah.
Brazil, Russia, India, China, and there was another one.
South Africa?
No, I forget. BRICS, anyway.
Yes? No?
That was, it was a million years ago. So I've got VTS. I've got Magellan Global Fund, which is MGE.
Jeez, we're all in agreement about that.
You've got that through the list.
Self-Wealth, yeah.
Yeah, okay.
Yeah. And again, like, that's an actively managed fund, and there is talk that, active. I'm like, I just love what Hamish is doing.
Yeah, they're the pros.
And I don't know, I'm interested. And I like going to their investor briefings.
Yeah.
I like hearing what they're doing in the portfolio.
Yeah.
It just really feels like this is sponsored.
I
We just got to say, it's not.
We just randomly all hold MGE. Do you hold MGE, sorry?
No, I hold it privately.
Yeah, privately. Yeah.
But it is the global fund.
Yes. I've got, and this is a little bit of fun that I invested in. It's a BetaShares ETF, and it's RBTZ.
Robots.
Yeah.
Yeah.
So the robotics and AI index, so it's heavy into Asia.
Yeah.
Have a look. That's had a banging 6 months.
Has it?
Oh,
Really?
Coronavirus. What's that? Yeah, totally.
Yeah.
That's great.
And that was, for me, that was a little bit satellite-esque. Again, I'm not going to talk about weightings.
Yeah.
And please, just because I'm doing something, don't do it.
Yeah.
I'm an idiot.
But this is what I love about these thematic ETFs.
Yeah.
You can get access to, if you're interested in cybersecurity, you can get ETF that follows cybersecurity. If you're interested in, I don't know, as I said, marijuana.
And they've all got great names. Like the cybersecurity one's Hack.
Yeah.
And
great marketing.
Love that. And then the little one that I talked about, like with Corona, that I may have just reversed the truck up to.
Oh yeah.
Was VAP.
Okay.
What's that for?
Vanguard, basically Australian Commercial Property Fund.
Okay. Yeah, nice. Yeah, we haven't talked much about listed property and different ways you can access that.
Because I'll show you this.
So you went hard on VAP.
Yeah. Look at that.
Yeah, bombed out.
Yeah.
Where did you buy it though?
I'm not disclosing.
Fair call.
Yeah.
So what's your thesis behind that?
I wanted some property exposure in the commercial space in Australia, and that's basically it.
So is that a fund that holds actual property, or
does
it hold like Goodman and stuff like that?
Yeah, like Centre Group,
Yeah,
Goodman, like it's your Westfield.
Hopefully not offices.
Yeah, they're going to be. Well, and that's that's going to be interesting, isn't it?
Yeah.
But again, that's just a bit of fun for me.
Yeah.
Yeah.
So now I want to finish up with, in terms of individual stocks,
Yeah.
are there some little darlings that twinkle your eye in Australia?
Are we getting very close to the line here, or what?
What line?
What line?
I like.
Friggin' the line's 8 kilometres back there.
my next buys are going to be City Chic, CCX.
Ooh.
It's an Australian company that specialises in plus size women's clothing, very niche, and they derive 2/3 of their revenue now from online, which I think super important given the climate that's going on in retail. But they absolutely own the space, and they are expanding pretty heavily over in the United States. Pretty small, I wouldn't say small, small mid-cap company. So yeah, I've got my eye on that. It's been doing pretty well. And I think I'm actually just going to put some money into Amazon. They're
But
buzzing.
you'd have direct exposure through MGE, like indirect exposure, wouldn't you anyway?
Yes. Yeah.
And that's why I just can't be bothered dicking around with the international brokerage.
Yeah, no, that's fair. But yeah, City Chic for me is the one that I'm going to next buy.
In terms of how hard it is to do international brokerage, I did a test on my phone. 29 seconds to buy socks from Amazon, 22 seconds to buy stock of Amazon.
Yo, good little play though.
So it's pretty easy these days.
You should record that and put it on our socials. Anyway.
Yeah.
Are you going to do, like, when you have, I was going to say, when you have guests on your podcast, you put like a photo on a quote or whatever. I'm like, I'm not on your podcast right
now. We can put it on our. So what about you?
Oh, no.
In terms of me, so I'm a little bit bearish at the moment. I'm a little bit nervous.
Wow.
I'm a little bit nervous about, JobKeeper ending and the US support ending and the amount of people that aren't paying their rent and all of that. So I've actually, I've put a bit more into gold, and I think I'm going to do a little bit more.
When you say you put money to gold, like, are you going down to Westfield and going to the gold
He's got some in his
counter
back pocket right now.
Yeah.
No, so there's listed funds that you can get exposure to the price of gold. It's pretty important if you're going to invest in gold that there are funds that give you exposure to the price, and then there are funds that actually hold physical gold, and you want to invest in ones that actually hold physical gold. The fund that I'm investing in, if you own over a certain amount, you can actually go and redeem the units in the fund for physical gold.
Yeah, right.
GOLD is the ticker, and it's an ETF securities. Is that the one you got?
No. It's the one that Jesse Felder recommended.
Oh, you've bought that one?
Yeah.
Oh, right. Well, it's the same with the ETF securities one, gold.
Okay. Yeah,
you
nice.
You can go and redeem.
Yeah. Anyway, so gold, and surprisingly enough, which I'm very surprised that I'm doing it, Bitcoin. I don't believe in it. I don't think it's.
I hold Bitcoin.
Yeah, well, this is what I'm doing. I'm doing a sort of
just for lols.
What if I'm wrong? Like,
yeah.
I understand the first part of the Bitcoin thesis that, and we don't want to go too deep here, but that all this money printing is going to devalue fiat currency, blah blah blah. I understand all that. I don't understand the second part, which is why is Bitcoin the actual alternative? But what if I'm wrong?
Well, I can tell you right now, the biggest thing that will stop Bitcoin from being anything good, well, I don't want to say stuff like this, but
yeah, here we go.
Until it will only be treated as a real thing when you can settle a government debt with it.
Yes.
Yeah, you like that one, didn't you?
Not bad.
Yeah.
So, when will that happen?
Will
we
it happen?
Know, yeah.
And that's what we don't know. So, yeah, I own Bitcoin only because the same thing is like, throw a few grand in there, whatever. But I hold Bitcoin only because, whatever,
Yeah.
Same. Why not?
Yeah.
Yeah. So for me,
a very small amount, like it's
yeah. Less than 1%.
Yeah. And then to answer your original question, if I was to look at individual stocks, I think, well, look, I said Shopify earlier, but I think Shopify for me is a very sexy business.
You've been harping on about Spotify.
No, Shopify.
I know, but you've also been harping on about Spotify.
Well, I think Spotify is going to own the podcasting space, and like we've all seen the big acquisitions that they're doing. But
what about the money they didn't tell you about with the Rogan deal?
What do you mean? What do you know that we don't?
Well, I'm just the facts are they've obviously said it's over $100 million.
Oh yeah.
Yeah.
Okay, but what about all the other money where they're like, we'll bring advertisers to the table? Like, I reckon they'll be like, if we bring an advertiser to the table, there'd be a rev split there.
100%.
Probably, yeah.
Like, he's probably talking.
He's cleaned up.
$100 million a year.
I reckon he was undervalued. I reckon he was clearing $30 million a year in advertising revenue pre Spotify, and he sacrifices a lot of his audience to go exclusive Spotify. Should have asked for.
We don't know
more
the deal though.
Gimlet Media money rather than.
Yeah, and it's clear that Apple are losing out, but Apple have obviously gone, well, we don't pay for content yet.
Yeah.
So
yeah, I think what I was saying before, some of those US tech names that aren't the big flashy $1 trillion companies, I think are particularly interesting.
What have you got your eye on?
Well, it's funny. I've had my eye on kind of 3 Australian stocks, and again, if I do dangle my toe in the water, it's not going to be more than 10% of my portfolio because it'd only be for a sport almost, and just because I'm interested in investing, and it would be long-term play. And actually, I answered this on an Instagram story, and some of you may have seen it a while ago. I'll start with kind of the boring stuff. I'm just such a fan of Woolworths.
Yo.
Get out of here. Coles is a much better business.
Piss off. It's like you go into the store and it's red, and it's like, what's with all the oppression and the angry red and
White.
red and white, where it's like Woolworths, it's green, it's fresh. At Woolworths at Bateau Bay, I know where everything is. Like, but no, I think the Woolworths, they stopped digging around in stuff that you had no idea about with the Masters stuff. That core business, groceries, just slaughtering it. I'm just a fan of Woolworths. It's a staple. I don't know, no reason. That's just a personal view. Like, if I said the same thing about Coles, it's actually based on nothing.
Yeah.
The other one, and I'm actually keen to go pretty long on at the moment, and that's Qantas.
Yeah.
Yeah.
There's a lot of talk
Yeah.
in our community about Qantas
And in fact, at the time of this recording, and this podcast probably won't go up till August, but I'm on Monday because I like commercial aviation. I fly a couple of times a year when you could, maybe to the States on Qantas, and I like it. I'm doing the 747 final joy flight in Sydney, so they're retiring the 747. I'm a total nerd, right? And then you go to the lounge before for some brunch, and then you go and they do a flight around Sydney for an hour. The flight's called QF 747, and at the end of it, they drive into the hangar, and everyone walks down the stairs, and you can get photos and walk around the plane and stuff. So
wow, there
it's
you
a bit
go.
of a nerdy thing, but I'm pretty. If I was going to put money into the market tomorrow, I would probably myself consider Qantas. Again, I'm not a stock guy, purely personal interest.
Yeah.
And that's why I limit it to the 10% rule.
Yeah.
Because just I want to.
Yep.
And then the third one, which I've had my eye on for many, many years, and I think it's probably now's a good time as any, and that's InvoCare.
Okay. Yeah.
They've got the licenses for, the cremation and
Yes.
funerals and all that. So
I actually pitched InvoCare.
You did on the show, yeah.
on the show a month ago, right in the middle of COVID.
Yeah.
I think I equally think it's an interesting play.
yeah. So on the 18th of March, mid-COVID, it was $13 a share. It's now 10.
Wow.
Yeah, so it's fallen off a cliff. They did do some capital raising 3 months ago. But I'm just and I think if I read correctly, they're into the Singapore market as well. So, we're not getting out of this place alive. We've got an aging population. To me, it just makes sense to also go long on that. I don't know. And again, all this crap is just only personal interest. I've not really looked at the financials of any of these companies, so I'm not telling anyone to do it. I'm just saying this is what I've looked at.
Yeah.
If I was going to do it out of personal interest. So
Yeah,
I like
nice.
it. We'll make an individual stock picker out of you yet.
That other podcast.
My millennial mates, it's coming.
Oh, I love it. But again, I can't stress enough, like, the reason why I don't do individual stocks is because I can't control myself. And I just, if I was going to dabble a few grand in or whatever, it's not going to be more than 10% of my portfolio.
Makes sense.
Yeah. So, well, we might leave it there.
Nice one.
That was a lot of fun.
It was good.
Yeah,
Thanks
it was
for
good.
Coming up and having a yarn.
Thanks for having us.
No worries.
It's good to see. Good to see where the magic happens.
Oh, yeah. It's good magic. It's good magic. You can find these guys anywhere you listen to podcasts. They've got a couple of podcasts. So much better that you rebranded your logo. Put it more forward, bit more colour, the strength behind it.
Yes. Yeah.
Love that.
Yeah.
I think big things are happening at Equity Mates.
Oh, look out.
Yeah.
Look out.
So yeah, we'll do the plug. Search Equity Mates or search Get Started Investing or go to equitymates.com.
Nice.
Or if you want an outdated website, go to the .com. But if you just want what's happening, go to Instagram.
Yeah. We're all over socials. Join us on Facebook, Equity Mates Investing discussion group, and we've also got a bit of exposure on Twitter as well.
And Bryce
Yeah.
is learning the Renegade dance to get on TikTok
TikTok's
very
big.
soon.
TikTok's big.
Yes.
Yeah, we are going to explode on TikTok.
TikStock, it's going to be called after Bryce is done with it.
Love it. All right. Piss off.
Thanks for having us.
See ya.
Thanks,
Bye.
Glenn.